Good afternoon, everybody. Welcome to session 23. My name is Ola Johannes Lind. I'm the CEO of WorldMiner. And today's topic will be leverage and market demand related to the WorldMiner platform. So let's start the introduction about WorldMiner. We believe that blockchain mining should not longer be a privilege of a few, and everyone should have access to its benefits. In the future digital economy, regardless of location or wealth, everyone should have equal opportunities to participate and gain. We believe not only together, but as a team, we move forward towards a more inclusive, sustainable, and transparent future. That is the reason why WorldMiner strategically works with WorldCoin to shape the future of cryptocurrency together in the AI-related new world in front of us. To address the regulatory gaps in WorldCoin's global market within OpenAI's grand vision, enhancing its reach and influence. We trust in the market potential of our own coin, ATM, which was developed to provide computing power that helps to fill the gaps left by WorldCoin. It offering a sustainable new market opportunity. Users can acquire that computing power at a low cost and earn returns from both WorldCoin and WorldMiner. WorldMiner and WorldCoin, both aimed at OpenAI's core initiatives, have both developed a robust cryptocurrency financial ecosystem. Their market education, promotion, and technical support are top tier, demonstrating strong capabilities. WorldMiner addresses the biometric policy barriers faced by WorldCoin in its global expansion by offering an unrestricted registration and participation platform for users across multiple countries. That move injects new momentum into WorldCoin's market value growth, and with WorldMiner's global promotion, both WorldCoin and ATM values are expected to easily grow many X. WorldMiner introduced a staking mining model that eliminates the need for expensive computer equipment purchases. User can stake a certain number of tokens to receive computer power allocation. Enables participation in mining and earning rewards. So compared to traditional mining, staking mining significantly lowers that entry barriers and reduces equipment and maintenance costs. That, with the ATM token positioned alongside WorldCoin, is of today undervalued. However, with the expansion of the project in the coming month and increased applications, the token price is expected to rise substantially, offering strong investment potentials. WorldMiner produces and provides not only basic staking mining returns, but also offer additional rewards through various incentive programs and activities. So by participating in staking reward programs and computing power competition on the platform, the user can earn extra returns, further boosting their investment gains. That is part of the grand vision of WorldMiner and OpenAI and WorldCoin, where we will go in the future from today and onwards. So let's dive into today's session. With market demands rules plays that crucial role in shaping any investment decision, specifically in digital mining. The demand for digital currencies is a major factor that influences that profitability of mining operations. So we can say when demand is high, the price of digital currencies rises. making mining more profitable, in turn attracts more investors into the market, leading into more increased competition and investment in mining infrastructure. However, when the demand goes down, the price of digital currencies falls, obviously, making mining less profitable and discouraging for investments. In addition to that price of digital currencies, other factors influence the market demand. That includes speculation, regulatory changes, and investor sentiment. That sentiment is a key factor, as investors are more likely to invest in digital currency when they are optimistic about the future of the market. The influence of market demand on investment decisions in digital mining is complex and multifaceted. Investor needs to carefully consider all the factors that can affect demand before making any investment decision. So it's important to remember that digital currency market is volatile and investors should be prepared for potential losses or gains, obviously. So the leverage strategies and the World Miner platform. Although digital mining doesn't directly modify the leverage of cryptocurrencies, it's important that miners understand this concept because it affects their digital assets very frequently. Leverage is a financial tool used by traders to amplify their potential profits or losses, and is not inherently tied to the mining process per se. However, the mining digital can indirectly impact leverage in a few different ways. Hash rates. The hash rate is, or the computational power used for mining, can influence the security and the stability of cryptocurrency, as a higher hash rate generates or generally indicates a more secure network, which can make leverage trading more attractive. Market volatilities. Mining can contribute to market volatilities, as miners often sell their newly mined coins, which can impact prices. This volatility can make leverage trading more challenging and also increase the potential risk of losses. The energy-intensive nature of mining can also influence the price of cryptocurrencies, which in turn affects the leverage available to traders. If the cost of mining increases, it could lead to higher cryptocurrency prices, potentially making leverage more expensive or risky. But leverage is also a complex financial tool that should be used with caution, because it can both amplify profits and losses. So it's crucial to understand the risks involved before using it. And I cannot stress that enough. And leverage trading is one of those controversial subjects. Some view instruments like futures and swaps are directly responsible for the wild moves in the crypto markets, specifically when the liquidity is not broad enough. Some see them as a tool to actually hedge said price moves and timber volatility. Some people see them as a dangerous product that have wrecked many inexperienced traders. Others view them as an essential tool when used responsibly. So who is right? Well, let's have a look at both arguments and break them down, separating fact from fiction. Well, leverage trading, what is it? Well, quite simply, it's trading with more money than you have. To expand on this, it's like entering positions on the market that are many multiples of what you're putting down as your collateral. The collateral is more commonly called your margin and is usually measured as a percentage the amount you can trade with. So if the margin is 20% of the position, it implies that you have a leverage about 5 times the margin is 10%, it implies you have a leverage of 10 times. This means that your position is levered up by a certain factor. Gains and losses are magnified by this said factor. Important to understand, and making sure before doing any leverage trading that fully understand how leverage trading works and how big percentage of that you are then to anybody that is giving you that leverage that you are responsible to. Very important. So we can say it can be enormously lucrative, but it can be enormously deadly at the same time. So it all depends on which side of the trade you are. So leverage trading is quite broad, and there are so many different instruments that you can leverage. You have financial futures, swap instruments, CFDs or contracts for difference, or even pure margin borrowing to trade. So there is an aspect of some of these leverage instruments that is their ability to be used to short sell an asset. That basically means that you'll be able to make money if, for example, the price falls on a set asset, for example. And we've seen that a lot in the financial market where some big hedge funds, they say in the currency trades, for example, they hedge a lot against fall of say Japanese yen, or either way, any currency where they can have leverage to manipulate and be part of that specific change that in their favor. So with future markets and leveraging, the idea of this future market was started first in the currency markets a long time ago in the early 70s. Then in the interest rates markets in the mid 70s, and later on into the stock indexes in the 80s. And in the end, you even was provided instrument on a single stock as well. And these were mostly traded by institutional investors on large regulatory exchanges such as the CBOE or CME or etc. And those traders would keep margin accounts at exchange members, which required less than the notional size of the contract. So these margins account was pretty high, and hence implied as a leverage of only maybe between 3 to 5 times. The fact today that future scenarios were not offered to retail traders is an important point, because there were indeed quite high risks that came with trading with them. Losses could be multiplied of the margin, and retail investors were not considered well versed enough to trade these financial products, right? So eventually, these did make their way into the retail markets through different online brokerage accounts like TD Online, etc. And they were first offered to US trader, and they remained mostly between 5 to 20 times, depending on what kind of asset. And these were brokers that was heavily scrutinized by the likes of the US Securities and Exchange Commission, etc., and the CFTC, etc. So, given then that the cryptocurrency market is largely anonymous, and anyone could have created an account, anyone could have traded them, and they did. BitMEX, for example, started generating a reputation as being a bit of a meat grinder for the small fry, and a number of rumors that they operate their own trading desk and use their users' position to their own advantage. Like you could see, for example, with the bigger financial institution like Goldman Sachs and all these others that is involved in financing different nations, etc., where they actually utilizing their own financial house, different departments to play a role where they make huge gains from trading on the both ends, because in the end, the client is paying them, and they have made a lot of money this way, and like the others has failed in the end, like Lehman Brothers, etc. But this is how you can win, gain, or lose big, as many of these trading houses as well, financial trading houses, has occurred during the last 20 years. So it's like similar, like playing poker with someone. They can see your cards, right? So traders still gather that to the exchange, but by the law of being able to make 100 times your initial investment on one single trade. And that was overwhelming, no? But not only were the cards stacked against these traders, because they had no clue what they were doing. So today there is an overabundance of futures exchanges that have opened up in multiple regions. Like a few of them, Deribit, Bybit, Femex, Cumex, etc., etc. There is many of them. And you can also have these numerous spot crypto exchanges that have either offered their own futures products or enable some form of leverage trading. This includes Binance, Kraken, Huobi, DM, OKX, etc. Even Coinbase has enabled some margin trading functionality on their platform, but with lower leverage limits. So, in my belief, people should not be trading with leverage strategies if they do not know how to trade spot. Because if you're not going to make a profit trading with no leverage, you're sure not going to do it with leverage. It will be the opposite. And you should not use leverage if you don't know how it works or how to manage it. And I think most people forget in the heat of the moment, it's a double-edged sword. They can also chop you down to size if not controlled on the other side. So for an example, many today do not still trade with stop losses. But maybe the biggest mistake this trader makes is the amount of leverage they take on. Exchanges with flash a headline number of 100 times leverage, and those new of the game will go in open and open an order. With that exposure, which sets them to perfectly as food for exchange liquidation engines. Even minutes move in the price of cryptos can have that large impact on the profit and loss of your position, your P&L. So it's not a coincidence that the leverage factors and the margin requirements on regulated exchanges or retail brokers is so much lower. They could either be down to regulations. Leverage is really needed for a product to appeal to retail investors. But the guys who manage billions of dollars are perfectly fine using this leverage. So why do you need 50 or even 100 times leverage? The main reason that anybody will want to trade with such high leverage ratios is because of the same reason that they throw some numbers down on a roulette wheel. They would like more to be like gambling than trading. So these are basically mechanisms that close out trades at the liquidation level. This liquidation level is usually above or below the bankruptcy level, depending exchange. Simply, higher leverage means more liquidations, which means more trades, which means more trading fees for the exchange. So for an exchange, when they're offering this, is because of this reason, because they make more trading fees. So when it comes to participation to take out leverage, think twice. Are you comfortable? Do you understand mechanisms? Are you doing a sure bet or you gambling? So have you traded in the spot market before? Have you developed a trading strategy or you're trading on emotion? Because this is the fundamental one based on price action or a more technical one that is shaped by the charge, the numbers. Do you have any money management strategy? When you have the answer to them, then you can utilize leverage strategies carefully. But you need to have the game plan in place. And you need to stick to the game plan. When to enter, when to leave. But essentially, you should also know exactly how much you're willing to trade. This would be viewed as a completely separate component from your huddle portfolio. And it should also be funds that you should be comfortable to be able to lose without breaking the bank. You should then decide on which exchange you want to trade. You have no shortage or different options anymore. The chances are that you are already using any of the big, large crypto exchanges. Then they could have a margin trading or future feature for you. Exactly what exchanges use would depend on the functionality you need, as well as the coins you want to trade and do the leverage with. And liquidity is the tool in this game, because caution. Liquidity is pretty limited, and you do not have nearly as much functionality or efficiency as a centralized exchange. And this is just the nature of DeFi currently. So leverage trading, when used responsible, can obviously optimize portfolios and actually reduce risks. It's not about the instrument itself, but it's how it's being used. Because irresponsible trading will wreck people, myself included, when I first entered crypto space many years ago. Because you entered on emotion, because you were excited about it, and you didn't pay attention to the basics. As a trader, if you are in trading, that should be your number one focus. Always to have the game plan in place. Not trade on emotion, but trade on the numbers. When to get in, when to get out. So, as they offer, like for example, when you trade a crypto 100 times, go all in, or some altcoins, or sink all into ETH or BTC or any other assets in a DeFi lending pool, risks should be assessed and managed. Remember, it's important. They all offer the same instruments to those traders with years of experience as they would do with you who just started trading a few days ago. So would a person that's just started, just like in mining, understanding, taking the first steps, etc., would they be able to handle the same as a very experienced trader knows how to utilize all the tools in his hands? Answers normally is no. And that's the same what we have done with World Miner as beginners coming on board, because mining is very different than daily stock trade or trading on a daily basis with crypto, because we are looking at long-term objectives. 30 days, 60 days, 180 days, 1 year, meaning that we're taking a long-term view of our mission, goal, and objective as a miner, not as a day trader where we are looking for the spikes, the volatility on a daily basis, 24/7. So it's important then to, as a beginner, start in a pace and learning each of the different modalities in a platform, for example, not taking a risk as you would as a crypto trader the first time you jump in on an exchange, for example. So you learn how it works. You don't have the same risk because your USDT, your principal is still there, secure. When you leave it, it doesn't go up, it doesn't go down, it stays intact. But the dual economy trading that you do, that gives you the reward of the world miner and ATM coins and the world coin, is where you then on a daily basis on the reward can test the waters and see how it works and learn all the different functionalities, the different modalities of how to do mining and staking, from liquidity mining to easy earn mining, etc., or nodes to be part of the whole infrastructure. So going back to these traders, so it's imperative when you do those margin trading on exchanges to understand exactly what you're doing, because utilizing high leverage is dangerous. Because, say, for example, we have less people trading this instrument as a casino and more people using them in a responsible manner, we have less people with unpleasant experiences. Moreover, if there is fewer people leveraging the market that way, we won't have those price swings that makes the market feels like it's a roller coaster. Enhance mining, where we contributing to the ecosystem, not only building the AI power computing with the GPU and CPU, but we're getting the rewards and on a much more sustainable basis, growing the ecosystem and our participation in digital economy and artificial intelligence. So when leveraging in mining, just to have all the parts of this discussion in place, is that miner uses the hash functions to process the transaction data by creating a hash that serves as that digital fingerprint of a block's contents. To find a valid hash that meets the network's difficulty target, maybe miners must perform trillions of hash function operations, a process that demands substantial computer power and energy. So the incorporation of hashes ensures that once a block is added to the blockchain, altering its content will require remining not only that block, but also substantial blocks. It's a practical feat due to the immense computing power needed. So the characteristics cements the blockchain's tamper-resistant nature, fortifying the network security and trustworthiness. By employing that proof of works consensus mechanism, and proof of works mining is a major method of stage and phase 2 of world miner. The cryptocurrency networks leverage the power of that cryptography to achieve the decentralization, the security, and the integrity. So the system underpins the function of many cryptocurrencies, includes main cryptocurrency, and will play a crucial role in the evolution of digital finance. As the cryptocurrency landscape evolves, so does also technology and strategy for mining. So from humble beginnings of CPU mining to now the sophisticated ASICs and mining pools of today, including the WildMiner platform, the journey of crypto mining is a testament to a rapid technological advancement in this field. And in the architecture of blockchain and POS, WorldMiner keeps the leverage high. By proof of stake, a revolutionary blockchain consensus algorithms where power is determined by the tokens you hold that allows multiple benefits. No more energy draining computation, just efficient processing and scalability. With this modality, validation nodes confirms the transaction, staking, and delegation for participation, that with an exclusive WorldMiner bonus system for rewards. The governance, determined by coin holders, ensures the network development, important, the energy saving, efficiency, and economic inclusiveness. So join the future of blockchain with POS, proof of stake, in WorldMiner platform, a method that anyone, anywhere can have a stake in the game. So please visit our website, worldminer.io, install the platform applications on your device, become part of WorldMiner today. You need more information or have questions or need to reach out. Our Telegram groups, WorldMiner Global and WorldMiner Brazil, WorldMiner Bulgaria, and others, please join them. You will have more information, more support 24/7 from our side. And we look forward to see you and your team on our platform. So thank you for today for listening, and we see you on the next session. Thank you so much. I'm Ola Johannes Lind, the CEO of WorldMiner.